Welcome back to the Online Investor's Guide to Thriving for July 28th, 2020. It's hard to believe we're at the halfway mark through summer. Somehow 2020 has managed to be both the longest and quickest year I've ever seen. Hopefully August will prove to be more laid back and we'll see you all again on the 27th for our next installment. Since we last spoke to you at the end of June, we seem to have more of the same. More global COVID cases, more economic fallout, more amateur investors piling into Tesla and tech stocks, more ludicrous valuations, and let's not forget more money printing. We've become really bullish on Canada, in fact, versus the rest of the G7 because we have the most trees. In case you didn't see the punchline there, we're not actually bullish on Canada. But if you want to know what we are bullish on, you can check out Larry's weekly market summaries on the official Larry Berman YouTube channel. The great part about these is they're just 2 to 3 minutes long, so you get an idea of what's been moving markets, and it doesn't take up your whole evening. Don't forget to hit the subscribe button and the little bell icon so you get a notification when Larry posts a new video. Berman's call continues to run at 4:30 p.m. Eastern Time on Fridays. Since everyone's trying to find a patio spot at that time, you can get all these highlights delivered directly to your inbox by signing up for our newsletter and by visiting bermanscall.com. If all that sounds like too much work, we can do the hard work for you so you can have more time to enjoy your day and still sleep at night. We've partnered with BMO to offer ETFs and funds of ETFs managed by Larry and available to you through your online brokerage or investment advisor. If you don't have an advisor, but do have a portfolio of $1 million and up, our ETF Capital Management Private Wealth team will be pleased to offer you a wealth management proposal. As you can imagine, this way of working together allows us to make the fullest use of our wealth management and investment toolkit. You can learn more or request a proposal online at etfcm.com. And if you just want to watch a replay of tonight's webinar, all you need to do is complete our event survey. Tomorrow morning, you'll get an email containing the survey. Tell us how we did, and you'll get a link to access everything above, and as well as submit questions for the next webinar. Investor's Guide to Thriving comes to you at no cost in favor of two causes Larry and I believe in passionately: sick kids and the Baycrest Foundation. We hope you can join Larry and I in supporting childhood leukemia research at sick kids. And we also appreciate your support for the groundbreaking work being done by the Baycrest Foundation into the treatment of Alzheimer's and dementia. For those of you who have made donations, thank you so much on behalf of Larry and myself. And for those of you who might like to make a donation, please use the links in the survey you'll receive after the event. That's how we track donations. And of course, Larry and I do match all of your donations. Thanks also to our sponsors, National Bank Direct Brokerage, who are bringing you Larry's first set of Investor 101 videos on YouTube starting next week. These are really great for people that you know who maybe don't have as much investment knowledge. They're looking for a starting place. So this is a new thing Larry is doing, completely opposite to tonight's webinar, where we really start with the basics. So those are going to start popping up on YouTube next week. Thanks to National Bank for that. And of course, BMO Exchange Traded Funds, who have been our top tier partner in investment education since they first started in 2009. Their efforts to inform investors are also top tier, and so are their friendly and knowledgeable ETF specialists. So with that in mind, I'm happy to introduce all the way from Vancouver, BC, Mr. Top Tier himself, Mark Webster from BMO ETFs.
Well, thank you. I think after an introduction like that, Jared, I need a disclaimer. It's summertime. I don't look like that at all. And dressed for the season, and I haven't had a haircut for several months. But thank you very much for joining us this evening for this session. We've got a couple of slides we'd like to go through to explain a little bit about responsible investing. And that ranges from socially responsible investing right up to present day ESG, or environment, society, and governance. We talk about this being the future, but really this is the present, because there's so much emphasis these days on how these elements have an impact on investors of all kinds, ranging from individuals right up to institutions. This actually has a long 100-year pedigree. In the 1920s, Quakers started to evaluate the investments that they held for the church, and they came up with rather exclusionary practices to say this was an undesirable exposure for us, that was an undesirable exposure. It's moved to the 21st century, where we look at these ESG, or environment, society, and governance parameters to gauge how we can allocate capital responsibly. In the past, analysts used to comb through the footnotes in annual reports to find out what the contingent liabilities were for a firm, to see if there were potential blockages or obstacles for capital growth within a company, liabilities that had not really been covered in traditional research and evaluation. ESG puts these things front and center. As an example, most of us would focus on climate change and environmental elements as being the largest, most sensitive parts of our investment strategies. But if we look at things like labor standards and human rights, health and safety, they are equally important. Imagine if you bought into a manufacturer that has poor labor standards or poor health and safety records. That could easily lead to strikes and dislocation. So what we're really trying to examine in ESG are reputational and operational risks that will have significant impact on our capital. So our role, going to the next slide, is really, this isn't just an investment management consideration for us. This permeates the Bank of Montreal Financial Group across all business lines. We've done our best to allocate our resources in different areas to make sure that the entire company complies with the high standards that are expected of companies in today's environment. When we talk about responsible investing, one of the topics that often comes up is this notion of greenwashing. Our goal right from the very beginning has been to integrate responsible investing into our investment process. And you can see by our long history here, stretching back to the 1980s, that this is not a flash in the pan for us. This is not a marketing exercise which we've embraced because others are doing it. Our roots go back almost 50 years, 40 odd years for doing this. What's really interesting is if you look at the slide, 2006, we were one of the founding signatories to the UN Principles for Responsible Investment. So this has been part of our DNA for a long time. Most people, when they look at responsible investing, look primarily at the exposure, but this is not just the exposure. This is also about how you act as a shareholder, a steward of capital. Since it's summertime, if I use the golfing analogy, it's not just the pace at which you hit the ball, it's also the follow through in your swing. That's where the voting and the influence you show in your engagement can be measured. And if you look at this, you will see that our voting history is a multiple of those of our competitors in the ETF arena. We've been doing this for the last 30 years as an active shareholder. Even where we're holding an index, we are still an active shareholder, not an active manager, but we're an active shareholder because we choose to vote in proxy events and to engage management for change. If you look at our own asset base, we manage about $300 billion in our own active share ownership. But we also do this as a service which we sell to third parties. We actually sell our consulting service as an active owner for over $300 billion. So in total, we're over $500 billion. And you can see we've won awards from recognized industry bodies for our sustainable practices, not only as a screener holding sustainable investments, but also voting actively and engaging management on a number of things. Now, most people would look at our track history and ask, where have you voted most against management? And the answer there is most of the time we vote against directorships and executive pay. The reason is that applies to 100% of the companies we own. Environmental concerns would be applicable only to a handful. So our record is higher on directorships and what have you. Our effort is to align our engagement and voting practices to make sure that companies are dedicated to achieving the UN's 17 Sustainable Development Goals. So there is a very set, established framework for engaging companies and voting accordingly. If we move to the next slide, I talked a little about the engagement. But what we've done is we've also partnered with MSCI to bring out a full suite of ESG exchange traded funds. So like our other exchange traded funds, low cost and transparent, very important when you're looking at these ESG exposures to make sure that they conform to your aspirations, how you'd like to allocate your capital. So we have them for the US, Canada, emerging markets, and international markets, and a global one. We also have 2 fixed income, and then a particularly interesting one, ZESG, which is a traditional global balanced 60-40 portfolio, the only one of its kind in Canada at the moment. And then for those who like the covered calls, we've got the ZWG, which is a global high dividend covered call selected from one of these MSCI ESG leaders indices. These ESG indices do not exclude industries or sectors, because to do so would introduce an investment constraint and also cause tracking error. Instead, they insist on 50% exposure, market cap exposure, to all industries to ensure that we're representative of the markets we're trying to capture, so Canada, the US, international, or global. And by achieving that 50% sector cap, we do it in a clean fashion, so we're holding the cleanest companies, the cleanest representatives across all sectors to make sure that investors can allocate their money according to their qualitative requirements. If you're looking for deeper dive into ETF ESG information, here are 3 sites that you can look at. One of them is MSCI. Provides full disclosure of their rankings of different stocks in their indices. So you can go on their MSCI website to see that. But we've also opened up our own information so that we can show you how we have voted on stocks individually and also collectively. So those the 2 second websites are things to look at. You can see how we've engaged management on environmental concerns, on social hiring and labor practices, and a host of other very important considerations. I'd like to turn it over to Larry now for the rest of the session, and I'd like to thank you very much for having us on this webinar.
Well, thanks very much, Mark. And you know, as an aside, my youngest daughter, Jordan, who's in her early 20s, in the middle of going through her formal education. She's about to do a master's in social work. So, you know, very happy and excited for her. And I asked her about her investments, and she has a TFSA, and I said, would you be okay if we put it into ESG type investments? And I explained to her what they were. There was a slightly higher fee and less performance. She said, absolutely. She said, I want to be a responsible investor. I said, well, how about if the fee was the same or lower, and you actually got the same or better returns? And she had a big smile on her face. So I think this is an area of weighting indexes and looking at being good corporate citizens for the next number of decades. It's going to be a big growth area. So it's pretty important people understand what all this means versus the generic, you know, S&P TSX index, S&P 500 index versus a basket of stocks that are just in general better companies. One of the factors I like about investing, Mark, is the quality factor. And it was very interesting. BMO did a quick study for me and compared, you know, the MSCI Global Quality ETF to this new global ESG ETF, and the overlap of good quality companies with good clean balance sheets and good free cash flow had a very, very high correlation overall to companies that were generally good corporate stewards. So, you know, pretty important learning and understanding there on what ESG is all about. So tonight I'm going to talk about Robin Hood from the poor. I'm going to look at the current earnings period, some valuation metrics that are a bit concerning, a little bit on the US election and policy related trade ideas, the rise and fall of the US dollar, and in particular, the battle with China. Want to reiterate and talk a little bit about why we're doing the YouTube channel and the whole idea behind our weekly picks and what we're trying to do there, and hopefully spend 15, 20, 25, 30 minutes on the Q&A part tonight. So I've set the bar really high for myself because I'm always a long talker on these things and always run over, and I will do my best to go be able to save some time for some live questions. The quality of the bounce, this rally we've seen, is Robin Hoodish, and you know the graphic on the top right there is the number of new Robinhood accounts, you know, coinciding with the market turn up and everybody, you know, not working. And you've probably heard some of the stories of people that used to bet on sports. There's a guy in the States who's got millions and millions of followers, and he actually had Trump on his podcast last week, I think, and has a lot of influence. And so they jump on stocks like Kodak, for example. If you can see in the middle chart there, you've got a company that, you know, creative destruction has wiped out like what they used to do and doesn't exist anymore. And they do very little. And if you actually look at their last annual report, which came out 2 months ago, there was no discussion from management whatsoever and no experience whatsoever in creating chemicals to service the PPE and drug supply industry. None at all. This company has zero expertise. And if you look at the volume of the chart, and you can see the stock went from a couple bucks, and incidentally enough, a handful of insiders and directors of the company loaded up on shares and stock options over the last couple of months since the annual. And you know, in the last couple of days, these guys have enriched themselves by hundreds of millions of dollars. So, you know, when it comes to corporate governance, I want to grab the CEO and literally, you know, give him the noogie, you know, like, what's wrong with you? And that's one of the things that I'm terribly mad at, if I can put it that way. The reason for the market rally here has nothing to do with quality, good economic growth. It has everything to do that's wrong with the economy these days. And I called it robbing from the poor, because Jay Powell finally admitted, and in yesterday's testimony in Q&A, not testimony, pardon me, finally admitted that, you know, inequality is a thing, and maybe they should do more for employment for certain, you know, cohorts. Anyways, the markets are up, and everybody loves the markets up. And but the quality of the rally. So when we look on the left side of the graphic here, we see the net flow into ETFs, equity ETFs in the green, and the net flow into bond ETFs. And you think about smart money and the volume traded. So in the bottom right, you're looking at calls plus writing puts. So those are bullish bets. And the difference between the bearish bets mean writing calls and buying puts. And you look at the volume that trades in each. And what you can see is the big volumes, the smart money, the big institutions are buying downside protection, where the speculator, the small sizes, are speculating and buying the upside. Now, right now, those speculators look really darn smart. But in every market, froth, you see the poorest quality of investors show up. And this is a poster child of that, this Robinhood Online. You can see it in the volume patterns and frankly, the speculation on Eastern Kodak, the fact that it was leaked out of Rochester and Washington, the SEC is going to come down hard on this, I believe, but I hope, and really punish the people who took advantage of this and listen, stole money from other people. It's, you know, frankly speaking, pension funds and other people that might have owned that stock. Anyways, the earnings has been good. The FANG names that reported today, you know, really outsized gains. So Wall Street is still playing the earnings beat game. That hasn't changed. So when you look at the Y estimate, that's the 2020 estimate of earnings, and the ratios, financial ratios on the bottom, you can see that on a trailing basis, 24 times earnings. The end of this year, we're trading at 25 times earnings. We're 1 year forward, end of 2021, we're trading at 20 times, 19.65. And 2 years from now, we're trading at 16.87. We're 4 or 5 multiple points higher. Okay, so if the earnings are expected to be 163 and 190, 4 or 5 times those numbers are what we're overvalued in terms of S&P points. So 4 times 163, it's roughly 650 S&P points. So where do we go on a correction, on a disappointment on earnings next year or this year, later this year? That would be kind of your minimum. And if you want a maximum, you have some kind of discount multiple. So not the fair value, but the discount multiple. And so I've said for a while, you know, 125 in earnings times a 15 multiple gets you, you know, 1,800-ish on the S&P 500 as worst case scenario. We didn't get that. I'm not sure we see that with all the government spending and Fed largesse. But make no mistake, folks, make no mistake whatsoever. Nothing has been fixed. All the challenges and problems of all the debt and all the money printing and monetization, it's only worse now. It's not better. Eventually, this thing doesn't look good, and the Fed and the other central banks kind of run out of bullets. So there's 3 ways to look at valuation. 2 of them are basically face ripping off the chart, overvalued. And one of them says the markets are fair value. And we're going to look at all 3 of them. So you're all familiar with the typical price to earnings ratio. A lot of criticism about that. They say you should smooth it out. So when you smooth it out like Schiller did, and looked at a 10-year smooth PE, it says the forward earnings are going to be way lower, 1, 2, 3% for the next decade, returns for stocks. And so when you buy a market at a high valuation, your average returns go down. But look at the valuation, the PE at 15 at 2,200. So at the recent low, we were fair value. We're slightly under fair value. Now, I thought it was going to go lower. I still think that risk is very high. I'm less certain about it, just given the absolute and sheer magnitude and willingness of the central banks and governments to spend money and monetize it, that we may not see those. My favorite valuation indicator takes enterprise value and it compares it to earnings. And so EBITDA is earnings before interest, taxes, depreciation, and amortization. And enterprise value is the amount of equity a company has outstanding, the amount of debt, so the amount of leverage on the balance sheet, and all that money that they've taken in, less the liquidity, the cash portion, and what earnings do they generate from it? And on an enterprise value to EBITDA basis, the markets today have never in their history been more expensive. So this is not a time to be bullish, but it doesn't mean the markets can't keep going higher because of the Fed. Okay, and I've said that for months now. Now, when you hear someone coming on BNN or CNBC or Bloomberg, whatever it is, financial media that you're looking at or reading, and they say the markets are reasonable value, what they're looking at probably is the comparison of the earnings yield from the S&P. So you take the PE and you invert it, and you get an earnings yield. So it's earnings per share. So the dollar amount that the S&P earns divided by the value of the S&P, and you get a yield. So that yield minus the risk-free rate. So this is called the Fed model. And it's a market timing tool. And how I like to do these things is look at them statistically. So what I've done in the bottom there is I've taken a 10-year Z-score. So Z-score takes the ratio or whatever indicator you're looking at, and it says in standard deviation terms, how far are we from the median? So I'm doing a 10-year average, and above the green line, we're cheap. We're 2 standard deviations or more undervalued or compared to the 10-year average. And when it's above the line, it starts to get expensive. And so this indicator, starting in 2016, along with my enterprise value to EBITDA, started getting very expensive. And so related to the cost of money and the amount of debt and equity, companies were expensive. And the markets have gone up still, right? And I totally misjudged the animal spirits around the support for Donald Trump and his policies. And I've said many times, you know, I was an advisor to Andrew Scheer. I'm socially liberal and fiscally conservative, so I fall on the center right of the political spectrum, but very clearly center more than right, very clearly. And again, all of the non-political, most of my beliefs fall on the left side, meaning I'm much more wanting to fix inequality than I am wanting to boost my own bottom line by cutting taxes and lowering corporate taxes and things like that. Now, I'm all for lower taxes. I am, if done properly, but the governments have never been good with, it doesn't matter what color team they play for. They've never been good at managing anybody's tax dollar. So, you know, coming into the US election, you know, the red states stay red and the blue states stay blue. And if you're partisan, you vote for the party. Sometimes you plug your nose if you don't like the leader, but you vote along party lines. And there's about 40 states historically that have generally stayed. And listen, over decades, because of migration patterns and things like that, the votes change. So you're starting to see the aging population that was in the Northeast kind of move south and take those Democratic votes with them. And slowly, Florida, you know, has become this swing state. And it'll be very interesting because the older vote in rural America tends to be very, very red, very, you know, GOP. But in the Northeast, that older vote that's more urban tends to be very Democratic. So it's going to be very interesting, but mathematically, those dozen swing states right now, here's the math. And this is why I said that Trump was going to win last time, even though Hillary was ahead by a mile in all the polls, and why he's going to lose this time. The reason he went after steel and aluminum tariffs and coal and those jobs related to them was because he needed to win the swing state of Pennsylvania mathematically for sure, and a couple others to win the election, because the base gets you a certain number of votes and it's always about the swing states. And Biden is ahead in the swing states. He's leaning ahead in Florida, and he's well ahead in Pennsylvania and Wisconsin, and Michigan is tilting now towards the Democrats. We'll see. But remember, Trump won by less than 1%, in total 78,000 votes. And a lot of those older rural votes in the last 4 years have retired and moved south, taking their vote with them to their new residence. So we'll see. We'll see. But I don't believe Trump will be the president come November. Now, today you saw him rail on the election, and what I believe is he's setting up a lawsuit that if they listen, they're going to vote by mail because some people just will want to vote, but they won't want to stand in line, and we'll see how COVID is in November. But I believe that it's going to be a big thing, and I believe there's going to be a constitutional challenge. Trump cannot unilaterally stop the election or change it. Congress can do it. It's never been done. Mitch McConnell said it's not happening. But if Joe Biden becomes the president, Goldman Sachs took some data of earnings based on FactSet earnings and numbers from the Tax Foundation and ran the things, and they said 170 is the baseline forecast next year. You've seen that number now is 163. $20, not necessarily next year, but in the next few years, as Biden's policies come into play, is going to cost the S&P $20 in earnings, conservative estimate. So that multiple that it's extremely high now is even higher under Biden. Now, Biden is probably going to spend more than Trump, but who knows? But for me, we don't know who's going to win. I think it's going to be Biden. Do I want Biden? Do I want higher taxes and wealth taxes? And no, I don't. But someone's got to pay for this, folks. So either it's that or it's the new modern monetary theory, and they just keep printing money until the cows come home, as they say. So, this is going to be really, really big, this change in earnings. And this is not remotely priced in. Now, when we went back and looked at all the other elections over history and looked at market sentiment around them, the markets didn't start reacting until after the conventions. Now, the conventions have been moved. They're normally in July. They've been moved to August. Next week, I believe, we'll hear the running mate. It's either going to be the who thought to be favorite, Kamala Harris, a senator who ran against Biden for president, dropped out early, supported him late, or Keisha Lance Bottoms, who's the mayor of Atlanta, who Trump and Governor Kemp are going hard on now because they're battling over the masks and everything else. So that one of those two is probably the running mate. It's going to be a black woman almost certainly. So any of the other names you've heard, probably not. And I think it's important who the running mate is because I believe Biden has clear evidence of dementia. And that's a problem for me. I couldn't vote for him if I was American because of that, unless the VP candidate was someone I thought who could be president. And so both those women, very impressive. Everybody has their own bits of baggage, but I think either one of them would be good on the ticket. Again, my humble opinion there. So we don't know who's going to win, but I look for trades and themes that I want to put in my portfolios that no matter who wins, obviously in a win, it's certain things are better than others, and I'll talk a little bit more about that when I get into the technology ideas, but infrastructure spending. And when I say infrastructure, I'm not talking about the BMO ZGI, the Global Infrastructure ETF, because when you look through that ETF, you own a bunch of pipelines and a bunch of utilities largely. And those are the ones that are going to be benefiting from the spending in largesse and trying to put all these people back to work, that there's going to be some pretty serious impairments there. So a lot of construction jobs, there'll be jobs in mining, that's where the reflation trade is, if you want to call it that. It's in the base metals. It's in the steel that's going to be reinforcing the bridges. It's going to be in the engineering companies that are going to be doing those jobs. It's not going to be in pipelines or traditional utilities when you think of infrastructure. Very, very important. In fact, for my firm, we're launching a private debt and equity fund to benefit from infrastructure investment. Again, not in traditional pipelines, certainly not here in Canada, but to actually get into, toll roads and real infrastructure, right? So I'm very excited about that, and it's not going to be in an ETF format or public fund. So that's for our private clients. So, and I think the private markets, even though they have risks, have far, far, far less volatility in them than if you look at the volatility of Brookfield Infrastructure Partners. Brilliant operator in terms of infrastructure, and it's a name to own. But the standard deviation of that through the ups and downs in the last number of months has been staggering. The lending market, the mortgage REITs, they pay out a lesser yield, and they had massive, massive volatility, where the private lending sector still has its challenges, but far less volatility. So I love infrastructure, but in particular private in general. But in the public markets, for the ETF players and stock players out there, look at the nickel on the battery side of things, on the clean energy plays, not the cobalt, and look at the steel and the zinc and the aluminum, and the copper. Copper's another big one. So ZMT, the global equal weight ETF. And this is a sector that's been underperforming for years and years and years, and is setting up very, very nice technically. I have a tiny piece in my growth fund. We're going to be adding to that. So those of you who own my BMO growth fund, we're going to be adding to that in our private pools for clients as well. The other one that wins, no matter who wins, because of the largesse of central banks and the free money world we live in, is gold. And this chart here is gold going back to Bretton Woods, early 1970s, when we came off the gold standard. You can see that jump in the chart there right at the beginning, and then the boom up into the cornering of the silver markets and the Hunt brothers in the late 70s there, and the big inflation period in the 70s. This chart adjusts gold for CPI. And if you look at where we are now relative to those peaks, we have somewhere between 10 and 33% more upside before gold hits some natural resistance from those old peaks on an inflation adjusted basis. And if you're following the gold markets now, you know that we've gone through the nominal price high from 2011 on gold bullion. Gold stocks are still 30-40% below those 2011 peaks, and that's where the leverage is. Someone asked a question about the gold silver ratio, and yes, late in the cycle, when this stuff gets exciting and money starts flooding into it, the juniors, the more speculative part starts to happen, and it hasn't yet, and silver starts to outperform. Far more speculative, far more volatile. I'm not going to play it, because relative to volatility, it's too high for my clients. But I love the gold theme, and I think we've got years to go on it before we see an ultimate high there. And finally, what I think works, no matter who wins, is technology. Someone asked a question about antitrust in technology. And we saw this week, those antitrust hearings for the first, sorry, it was last week, the antitrust hearings. And that's going to be very real. And they may try to break up big tech. And obviously under the Democrats, that's a higher risk. But technology is still going to work. And the future is all about digitization. Cybersecurity can't be a more important area for growth over the next number of decades. The next generation of internet and connectivity and 5G and 6G and 7G and 10G, and all the G's to come, the internet of the connectivity of the world, the internet of things, robotics, artificial intelligence, clean energy. I got a thing, I am doing some renos at my house, and I was looking at putting solar panels on, and we're at the point now where it's cost effective. And my contractor sent me a link to a Spanish company that has these really small rooftop wind. And in my area of north of Toronto here, wind is a thing, and I can get it all year around versus the drop off of solar in the winter. And in fact, on a dollar for dollar basis, it's actually makes sense. And it's quiet. You can't even hear these things go. So, clean energy is going to be big. Technology, software, as we work at home, and these things are very expensive today, and I wouldn't buy into them now on a risk-adjusted basis. But these things are going to work for years and years and years. Emerging market technology in that part of the world, a couple different ways to play it. And if you want, for the dividend people out there, TDIV, I've asked BMO to create a global technology dividend focus ETF. I'm hoping they listen to me. They often do. But there's one in the US, TDIV. It would be great to have a global one, maybe with a currency hedge, way to play it. And then the healthcare side of things. And I think one of the best ways to play is through the genome and the brilliant research they're doing now. Some people might have religious challenges to that. But I think in terms of longevity and healthcare benefits, this is an extremely interesting area. So own what you love, own what can work, own what will work, and learn how to hedge. And this is what we do in our portfolios. We use options to hedge the market risk side and try to own as much as what we like on a risk-adjusted basis in the portfolios. So again, talking about quality here and the moral hazard question. So Peter Bookvar is a guy I follow. He's a great US market analyst out of the States. And in his report today, he made a comment, and I thought it would be very relevant to share. So this is a new page I literally added this morning to the presentation tonight. I always like fresh things. And he said, here are a bunch of things that the journalists should have asked Powell, but didn't. So, speaking to the moral hazard questions and why they're doing what they're doing and boosting the stock market. And listen, you're buying the debt of Microsoft, Amazon, Apple, and Berkshire Hathaway. WTH, smack in the face. What are you doing? And he sits there calmly, and he says, well, it's of market functionality. Like, you want to punch these people. I do anyways. And so, I'm mad at the quality of the rally, and I get the don't fight the Fed, and I bow down to it. And the first book I read in the business going back 30 plus years was Marty's Wag, Winning on Wall Street, 1986. And brilliant book. Everyone should read it. Don't fight the Fed. Don't fight the Fed. Always, always, always. The money printing is big. But again, as to the quality of what it's doing and the problems that it's causing with inequality, this inequality issue, to me, not everyone understands my line of thinking here. This is why people are going to vote left. This is why, not because they want socialism, but because the reason they voted for Donald Trump is he was going to make America great. And you know what he's done in 4 years? Nada. He hasn't made America great. And so not that Biden is going to make America great, but the left policies are going to try to rebalance through wealth transfer. And it's just going that way, folks. It's not what I would support or vote for, but that's what I see and I observe, and we're not ready for it, but it's coming. And, and with 10,000 people a day turning 65, how are these people with zero interest rates going to save safely for their retirement, which is a thing I've been railing on for years and years and years. Big issue. Another big issue that I've talked about is this Cold War with China. Ray Dalio, again, I talk about his research all the time on these things and on Berman's Call. And this was the subject of my Berman's Call blog on an educational part of the show last week. And I showed this graph here and put the link to the first two parts of Dalio's work on this. And he went back and he looked at the cycle of the reserve currency status of the world, and going back to the post-Renaissance 1500s, 1600s, it was Holland who was the first European center of trade versus emerging Asia in the Dutch East India Company, and it led to tulip bulb mania and that bubble, and that lasted for a couple hundred years. And then as the steam engine was developed and improved upon, industrialization took over, and the UK and Germany, and once the US got through their wars, the War of Independence, 1700s, and then the Civil War, once the US got through their wars, their manufacturing powerhouse took off. And as Europe was going through their great wars in the first part of the last century, the US took over and now China wants to be the world leader. And I think this is measured in decades and maybe a century to come. So not tradable today. It's not about soybeans and phase one and phase two. That's all market narrative nonsense for political consumption and to boost the stock market, frankly. This is about the US losing their privilege, because they couldn't do what they're doing, because Japan's been printing money and buying stocks, and their stock market's been sucking for the better part of 30 years. Their bubble burst in 1990, and they haven't recovered half, adjusted for inflation. So, is this the demise of US leadership in the world? And it's the very early stages. But where are we? The debt burst, printing of money and credit, revolution and wars. This is where we are. So I think how this plays out in the next number of years is China is going with their Silk Road initiative, is really trying to control trade on that side of the world, the eastern side of the world. And if the US doesn't play with their allies well, and they're not under Trump through his trade rhetoric, and certainly against Germany, that it's possible that the European bloc links to China. I don't think so, but that's a big risk. If that happens, the US dollar's done. 20 years, 30 years, 40 years, I don't know, down the road sometime. But the world's got its challenges. We're at peak globalization, and that, to me, folks, means inflation is coming. Another reason why base metals and precious metals are very interesting as a trading theme, as an investment theme for years, perhaps into the future. So I think we're going to see inflation. I think it's bad for capital markets. Go look at bonds market performance and stock market performance in the 1970s and tell me that if we get the inflation over the next decade, what's that going to mean, and do you want to own the market today? And we'll see. Do that analysis, and I think you will not be too happy with the outcome there. So we started this YouTube channel. It's been about a month now. We've got 3,000, 4,000-ish coming up on, I think, viewers. So thanks all for that. This is another way for us to reach with our education mission. And we've got some great content, webinars like this will be up there. And really, you can give a man a fish and feed him for a day. You can teach a man to fish and feed him for a lifetime. And I love to learn, and I love to educate. And some people say, I watch your webinars and I don't understand half the things you say, and can you make it simpler? And listen, that's my mission. I do want to help people. I want to help people, do better. The reason we called our company ETF Capital Management was because I was so inspired by what ETFs help people do in terms of asset allocation in their portfolios. I'm not against picking stocks at all. I'm just saying, to get the benefits of the core benefit of investing and pooling money together is diversification. And almost nobody has enough of it in their portfolios. And bad things happen when you don't have good diversification. But it doesn't mean you shouldn't be picking stocks at all. So this is our channel. Please follow it if you haven't already. And there's going to be a lot of great educational content. We're doing an ETF 101 series sponsored by National Bank, as Jared mentioned. We're going to have a lot more good content as we build it out over the coming years. And so now let me get into the Q&A. So as always, first we go to the prepared Q&A that people took the time to write in, and then we'll go to the live Q&A tonight. And if everything works well, I'll be able to bring up my Bloomberg screen and we can have a look at things there. So question here about antitrust. So this was the one that came in about antitrust, and is it worse under the Democrats? So I believe it would be worse under the Democrats. They have far more of a mandate to make corporations pay their fair share. And to me, I believe it's egregious that a company can take its earnings and hide it offshore and not pay taxes. It's grossly unfair. Now, to Trump's credit, he tried to fix that, and as part of his tax package was a bit of a deal for people to bring money back home. And so what did they do with the vast amount of that money? They bought back their shares and largely enriched the shareholders and the C-suite, further worsening inequality. So, you know, when the president talks about making America great again, to me, making America great again is the American dream and giving everyone a fair chance. And all the policies that the Fed puts in and all the spending, it doesn't get to the bottom half nearly enough. So Biden's policy for boosting minimum wage, I'm a huge supporter of that. You got to do it slow and measured, but it's outrageous that minimum wages haven't kept up with inflation for 40 darn years now, and that's outrageous. So all these things are going to be fixed in due course over the coming years. It's going to add to cost. It's going to be inflationary. It's bad for margins. These are very important things. So in addition to some extra oversight and perhaps forcing some of these companies to diversify and maybe sell off some places where they have high concentrations of market share, you're going to see higher taxes on all these guys under the Democrats, certainly under a sweep. Can I explain the mechanics of how governments might try to inflate their way out of the debt? So the idea of inflating your way out, if inflation is rising, the dollar, you borrowed $1 last year, and now inflation is 2%, now that dollar is $1.02. As long as you're not increasing that dollar outstanding and it stays the same, and inflation keeps rising, now 20 years from now, that bond comes due that cost you $1, but on inflation adjusted terms, that dollar is now worth 50 cents. So you're paying it back in future dollars that make that debt inflation adjusted cheaper. That's the idea of inflating away the debt. They're going to do some of that, but that only works if the size of debt relative to GDP or how big your economy is growing, and i.e. your tax base is growing, so that you can pay it down and decrease the amount of debt. Within 5 years, folks, at the current expectations, the US, even at a 2% interest rate, the US is going to be spending $700 to $800 billion a year just on interest cost. So the incentive of the central bank to buy those bonds so the interest gets paid to the central bank, which in turn disappears because that money goes back to the treasury, is huge. Again, another great reason for gold, because it's inflation. It's going to come eventually. Under the Democrats and a Democratic sweep, universal basic income, more money in people's hands, higher wages, again, inflationary. So we're going to see this coming. Costs are going up. Attention, Walmart shoppers. Thanks for hosting the webinars. Well, you're very welcome, Jojo. Love your new YouTube. Well, thank you for watching. Gold over the last month went from low lows to high highs, and what's the catalyst? And further negative interest rates. So we're seeing real rates, so nominal yields minus the rate of inflation, get to the point where the US 10-year is something like minus 90 basis points now on a real basis. And when gold has no competition from yields, it's very, very attractive. One. Two, through COVID, there's been supply constraints in the mining industry because people couldn't work, tight spaces, that kind of thing. So that's a small factor. And then you have massive investment demand. So as jewelry demand has come down with rising prices, because a lot of people, say in a place like India where gold is a big part of dowries and things, as gold prices go up, they migrate to silver. Hence a reason for silver to gold ratio to start working later in the cycle, things like that. So that's been behind some of the volatility. Don't get caught up in the noise, Jojo. Understand the theme and the trend and why you're investing it, and buy the dips. Don't buy the breakouts, buy the dips. And the dips will come, but buy the dips and understand the theme is in place and it's likely to be in place for a long time, notwithstanding the day-to-day or week-to-week trades that go on in the space. And that only really matters to day traders, not position traders. John is 45 and he's looking to get into about 20 stocks, buy and hold for retirement. Warren Buffett-like, preferably Canadian value dividend-paying stocks, about 2 per sector. I'm comfortable with a few US names too. But what 20 stocks should I invest in? I can send you the 35 I was thinking of, but I'm having trouble narrowing it down. I have about 75,000 to invest right now, and hopefully adding about 300 a month going forward. So John, what I would do is buy an ETF that factors the best quality of dividend-paying stocks, and whether it's the BMO ZDV. I bet if you looked at the ZDV, or the XDV, the iShare version, or the Vanguard version, or there's any number of them now, and look at the names of your 35 and what's in there, and understand that that's the basket of the better quality names, you can probably whittle your list down from that. So if you want to own the individual stocks, fine. But you're making a mistake. Now, if you're in a taxable account, put the Canadian names in there, so you get the benefit of the dividend tax credit. But if you're talking about you're 45, most of your money is probably in registered accounts, RSPs, TFSAs, the like. The dividend doesn't matter. Get the dividend from Europe, get the dividend internationally, and get the growth. Canada lacks healthcare. It lacks technology outside of Shopify these days. And so the growth areas of the next decades, Canada has almost none of. We're past the best before date for our banks and insurance companies. And if interest rates are going to stay low because they need to for decades until the inflation shock comes, which it will one day, those low rates and flat yield curve are bad for bank growth. And they're toxic for life cos because they need to fund that promise of insurance that they sell at about 6 or 7%. And that's why insurance companies are piling into private debt and equity, because they're getting such attractive yields there. So look at what the smart money's doing and think about that. And that's one of the reasons too we moved to there. John asked about inverse ETFs, and I couldn't understand the decay and the daily reset. So in a single inverse ETF, there is typically no decay, but it depends how it's done. So if it's using futures contracts, the futures contract has a time value and a money value to it, and will trade at a premium or discount to the spot market. So there's a factor of decay in that, but 1-to-1 every day, there's no decay. The problem exists in the leverage ones where you have 2-to-1 and 3-to-1 rebalancing. So every day the market's up, they need to buy more to get the same 2-to-1 the next day or 3-to-1. And every day the market's down, they need to sell some of that underlying swap or futures to get the same 2-to-1 rebalance for the next day. And it's 2-to-1 or 3-to-1 on a daily basis. Now, a couple of them have modified how they rebalance that. So you have to look into those specifics, but I don't use any of them. You're pretty safe in terms of NAV erosions on the single ones. Okay, hopefully that answers your question, John. I have 500K in my RSP and the same in my registered account. Well, great for you, Peter. You're ahead of most. If I were to put all my RSP in something like ZZZD, and a reminder for everyone, that's the sleep at night dividend ETF that I run, and all in my registered in VBAL, so that's the 60/40 Vanguard balanced ETF. Would they add or neglect one another? I guess offset maybe is the. So I'm doing something very, so VBAL is not active. It rebalances back to the 60/40 target periodically. I'm not sure. Vanguard might be annually, could be semi-annually. But it's owning just generic S&P 500, TSX, international, and I'm not sure there's any emerging markets in those, and the equivalent of bonds. You have 40% of your portfolio in VBAL that has a yield less than 1%. And after inflation, that yield today is negative. So the traditional balanced portfolio is impaired. There's a huge part of that portfolio that's not going to be working for you very well. And so while I use bonds as a placeholder in my sleep at night fund while I'm waiting for stocks to sell off and for sectors and parts of the world to get to better value, and then I sell the bonds and buy them. You're not getting that in VBAL. So we're far more active, and in some respects, they might complement each other a little bit, but they're very, very, very different in terms of what they're targeting. I focus on yield and dividends, and VBAL just buys the generic indexes. So hopefully, Peter, that gives you some insight into your question. Thank you for that, and for your trust in me as a portfolio manager. Can you kindly discuss option strategies for trading indexes such as S&P and QQQ NDX is the NASDAQ 100? What is your philosophy? So there's lots of different things you can do for option strategies, and we're going to be doing more education on our YouTube channel around options, so tune in for that. We may pick, maybe even next webinar in August, we focus only on options. And if that's an idea you like, by all means, let us know through the feedback forms that you all get after these webinars. And I'm happy to spend a whole hour on different option strategies. But you can use them for speculating, you can use them for hedging, and you can use them for defined outcomes, meaning I have a scenario in mind where I think this is going to rally to this level over this period of time, and you can structure an option position around that. So let's say, gold, the gold ETF is trading at $42 approximately GDX. I didn't see exactly where it closed today. It's around that. But you don't want to buy it at 42, but you want to buy it at 38, okay, to say roughly 10% lower. So I'm going to write a put for the next 6 months at 38, and I'm going to get paid some amount on that. It may not get there, so I'm going to use the premium from that, and I'm going to buy a call. So I think gold stocks are ultimately going to get back to their highs from 2011, call it 60, 65. So we're at 42 today, and I want to capture that 60, 65 over the next 6 months. So how do I do that? I'm going to buy an out-of-the-money call for 50, and then I'm going to sell a 65 call because I don't think it's going to go higher than that, at least for now. And the cost of that call spread I want to take the value of what I got for selling my put. So let's say it's 10% of my portfolio and I sold my put and I got, X number of dollars. I'm going to take those dollars and I'm going to buy the equivalent amount of that call spread so that if it does go up, I get the upside. So now I've got a defined outcome where I'm going to make a $15 profit in my call spread if it goes up to those levels in my time frame. But if it doesn't and it pulls back, I'm going to buy it 10% lower and I want to buy it there, and it's win-win. So there's a lot of different ways you can use option strategies. You can use them to protect portfolios by simply buying a put. And if you don't want to spend the premium on buying that put, you can sell a call to pay for the put. And if you have only a short-term horizon where you think it might fall 5 or 10%, you can buy a put spread and lower your cost and so forth. So I can talk about all those things, Jeff, if you're interested. But many philosophies. There's many different ways to use options. They don't need to be complicated, but they're excellent tools, and we use them extensively in our portfolios. Brandon is asking, you talk about type of ETFs you want to own at some time in the future. Could you tell us the type of ETFs you want to own if we enter a depression? Wow. Okay, so my good friend and my favorite economist on the planet, David Rosenberg, and a couple months ago we had him on this event right here that we did, and we talked about all kinds of things in the world. He is now calling this a depression, not like the 1930s, but in the sense that people's behaviors are going to change materially from becoming a spender society to a saver society. And you're going to see saving rates go up, which is going to impact Fed policy. And the reason they put interest rates to zero is to stimulate aggregate demand growth. And if people are going to be more conservative with their money, and even more so those 10,000 people a day in US that turn 65, and 1,000 or so in Canada every day that turn 65, and now they're not working anymore and their money needs to last for 30 or so years in retirement, they're going to get a little more frugal, because for the top 20% that has saved enough, they're all good. And for the next 30% that are on the bubble, they're going to be a little conservative. And for the bottom half that haven't saved enough, they're going to have a material change in their standard of living from their working years. And they're not going to have a choice but to save more. And so he's calling it a depression because COVID has accelerated a lot of things that people have been thinking about, and it's that change of behavior. I used in the analogy of my wife's grandmother, if I can use this and sound politically correct, but I always wanted a BMW. It was one of my goals growing up in poverty to have a BMW. I don't know why, but anyways, 30th birthday. I'm making enough money. It fits in the budget, and I lease a BMW. And then we drive to Montreal for the Jewish holidays. And my wife's grandmother escaped the Nazi persecution, born in Poland, spent the war in displaced persons camp, lucky to be alive because many people didn't make it. And when she saw that I bought a German car, didn't speak to me for a year. She couldn't comprehend 60 years after the war why I would support Germany. And it's that type of behavioral change that this COVID is going to have on the margin with people. Not that exact thing, but that we didn't have enough, we weren't ready, we lost our job, both of us weren't working, we couldn't make our mortgage, and people are just going to get a little more frugal. So what works? Everything I've talked about, technology, infrastructure, those things are going to work gold because they're thematic and they're part of what's likely coming. Things that do better in inflation environments, real estate, for example, and so forth. So Brandon, hopefully that gives you some insight into my thoughts on that process. Joan says, thank you for hosting again. Joan, you're very welcome. I love doing this. I love educating. I love sharing. I think one of the successes of the Berman's Call show, coming up on 14 years now, it's a labor of love. I love doing it. I love sharing. I love learning. It keeps me sharp. I have to do more research so that I can share ideas with people, and it's great. Well, I miss Kelowna too. It's a part of Canada that's just immaculate, and I love going there. And my wife's good friend actually just moved there, and so I think we're going to, once we're able to be free and clear of COVID, certainly pay another visit, and maybe for a vacation. You want to learn more about the basics? Well, the YouTube channel is where we're doing an ETF 101, and there's going to be some insights there. One of the reasons I started writing a book 5 years ago, 6 years ago, and I haven't finished, and again, labor of love. I only want to write one book. I wrote a textbook on technical analysis for the Canadian Securities Institute more than 20 years ago now. But I want to write one book, and it's a little bit about Larry, and it's a little bit about how to do it better and how to make better investment decisions, and understanding you're not going to be right all the time, and all the biases that cloud your head and hindsight and all those things. So I'm writing it. I want it to be perfect. I pride myself on doing an A job on everything, and so I'm taking my time with it. But that's going to be a lot of where that comes out, Joan. So thanks again, and the YouTube channel is going to have a lot of stuff in it going forward. The return of capital, David's asking on ZPay, and how do you know if it's good or bad? I think I mentioned before, you got to call the company and ask them, because it's not in the disclosure. Is this a good return of capital or a bad return of capital? The bad returns of capital, to reiterate for everybody here, is when the underlying is earning 3%, but they're paying out 6 or 7 because they want to attract you to the higher yield, but they're giving you part of your own money back as a return of capital. And it's more of a marketing thing to boost the yield, where the good return of capital is, so in month 1, let's say the ETF has 100 million in it. It's very successful and lots of money's coming in. And in that second month, a dividend is paid by all the underlying holdings at the 100 million level of, say, annualized 3%. And now the months goes by and the dividends due, and there's double the money. So instead of paying out the full yield, they would pay half because they only got half the money. But instead of doing that, they pay out the full yield based on the 200 million with the new money, and that is a return on capital, but it equalizes it and makes it fair for all the shareholders. So in the growth phase of an ETF, there's sometimes, depends how fast it's growing and when the dividends are paid. So there's no easy answer here, David. You got to ask the ETF companies about it, and that's the differentiation between that illusionary yield that is your money coming back versus the good kind, that it's your money coming back, but it's for the right reason, not the wrong reason. Okay, so if all works well here, I'm going to see if I can bring up my Bloomberg screen here and have a look at some of the live questions that have come in. So can everybody see my Bloomberg screen in the Q&A? I believe they can. First question, Kat asked about Oracle. So let's have a look at Oracle, big tech name, ORCL, and I'll take you through a little bit about how I go about looking at a company. So first picture, okay, shock like everybody else. Flatline, it's not a lot of growth there. How about the last 5 years? Moderate growth, not tremendous. So this is an underperforming stock. So I set up a screen here where I can compare this to the world index. And so what I've done here is I'm comparing Oracle now, and what this bottom line is Oracle compared to, so the relative strength of Oracle compared to the world index VT. And over the last decade here that we're looking at, the line's pretty darn straight. And so Oracle's been a market performer long term. That's what it looks to me as here. So that's not bad. When I look at the fundamental side of things, I look at a few things, but I do like to see what analysts are saying. So I look at consensus here. Now, there's some websites where you can get some of this intelligence on it on the discount channels, but don't ask me about the discount channels. I don't use them. I've seen them, certainly. I'm familiar with them. I don't have a strong view which is better than the other. They all do great stuff, and they have great things and tools for you, that I can say. So, $54 price target is the 12-month forecast by this basket of all the people, 32 analysts that cover it. 25 of them have their targets, and you can kind of see some of them there. And most recently updated, last couple of days here, and those numbers maybe a little bit higher. And so there might be a little bit of upside in the analyst community, but there's a lot of holds. There's not a lot of love for Oracle. I would say if you're going to buy it, you got to buy it on a dip. And so, where again, let's go back to our chart here, and where would you buy that? And so obviously recovery, there's clear support there, but I would say if there's another swing down, which I believe there will be into the election, these lows are vulnerable. You're going to get stops below here. So another zone of support would probably be in this upper channel here. So I would say, mid 40s in here would be ideal on where you can be very comfortable risk return in buying it. We could see the lows again. It's possible. So that's kind of my 2 cents on Oracle there, Kat, and a bit of how I look at that. I don't get to analyze them, like that on BNN, because they want me to answer the questions so we can get to as many as possible. Any comments on the gold silver ratio? Well, I did comment on it. We can look at it in the ETF world. So whoops, we'll blow that up. Why not? So let's do SLV for silver and US equity. So this is the silver bullion ETF, and I'm going to look at it on a ratio, and I'm going to compare it to GLD, the gold bullion ETF. Okay, so I've got now the ratio here. So they're both of them. There's the ratio. And we can go back a number of years here and have a look. And so this is the ratio. It's been underperforming. Let's see if we can go back and catch the peak if both these ETFs go back far enough here. So there's the 2011 peak of the gold silver ratio. Here's where we are today, underperforming. It looks like it's breaking out here. So, it's probably, is it going to do this? Hard to say, but silver's got some runway here. It's higher risk. There's going to be more volatility, therefore more ups and downs in your portfolio. But I like it, and I think the setup is there for this. What do I think about Joe Biden and the big tech sector? I think Linda, I think I answered that one in my prepared remarks. I don't have sound. Okay, well, hopefully you figured that out, George. Any comment on total taking a multi-billion-dollar write-down to exit the oil sands? So I don't, Alan, I don't dig into the micros of companies. I stay macro, I stay thematic. So I don't have an idea. And this is total SA, I guess the French oil giant. And are they going to pull out of Canada? I frankly, I didn't know they were in Canada. So I don't have an answer for you there. But what I can tell you is I believe that we're going to be under liberal rule in Canada. Again, remember, I fall on the conservative center-right side of the political spectrum here in Canada. But I believe we're going to be under liberal rule for quite a while. I don't believe Trudeau is going to run in the next election. Very good chance Chrystia Freeland is going to be the leader. There's going to be a leadership challenge. What I'm hearing from the inside side of politics is she's not well liked actually by the caucus. So she's by no means a layup. It'll be very, very interesting how this scandal plays out on and if they call a snap election. They've told us as a riding president for me, for the Conservatives, and Thornhill for Peter Kent, who's got to be one of the best MPs ever, and is the ethics chair. So we actually talked a lot about the scandal in our monthly update call, which we had last week. And he thinks this is ultimately going to bring Trudeau down. So maybe that's a little politicking, but my point being that the oil sands under the Liberals is not going to develop. And if I was running a company and there were other places that were more friendly for investment, I think it's I would make that decision perhaps. So. What do I feel about GLD and CGL right now? I'm Patrick. I'm bullish on gold. Buy the dips. Buy the dips. And make sure you have a position on now. What are my insights to oil pipelines? And I own AMLP. It's a position that I own for yield, Matt, in my portfolios. It's a challenging environment, but I believe that we'll go through a restructuring, that oil hasn't gone away, but under the Democrats, are they going to ban fracking? Now, I believe if Bernie was the leader, the answer might be yes. I can't imagine under Biden that they would ban fracking. But definitely there's going to be much more incentive to invest in green technology. And I will underscore this. The biggest investors in green technology in the world are the oil companies because they want to be the energy companies. How that energy is created and developed is going to change over the years, and you have to understand that. And that's why Chevron and Exxon Mobil are investing in generating energy from corn and generate from food and from biomass and all these other alternatives as the world changes. And it's part of ESG that Mark talked about at the top. So I own AMLP for the yield, but it's going to be impaired for a while. It's not a growth story at the moment, but I think it's a great yield play, and I own it for that. Soros broke the Bank of England. Fed is not infallible. DJ, I didn't say the Fed was infallible, but the Bank of England and the British pound was not the reserve currency of the world at the time. And at the time, if you remember why, it's because Europe was trying to come together in what was called the exchange rate mechanism. And I fundamentally believe and still believe that the euro doesn't work. And the reason behind the euro project and the EU and having Europe work together is so there's no other war there, and to diminish that risk coming together, and that was the philosophy between the European Commission originally after the war, the European Union, but fundamentally the economies are so different they don't work. Now the big band-aid has come in. You got Germany and France to underwrite these commingled bonds now, and Italy's going to get some free money on the German taxpayer. And folks, that ain't going to last. It's not going to last. It will break. So for all its challenges, The US economy, even under the current leader, is still the best dirty shirt in the laundry. And if you believe there's a better option than the US dollar, what is it? And don't tell me Bitcoin, because I'll hang up on you. But gold comes to mind. What is the short and longer term view of the Canadian dollar? So Canadian dollar, let's bring that up here. So CAD. And let's do a very long-term chart here. So I'm going to go max, see what it gives me. So we're going back to the, coming off the gold standard and floating exchange rates. Parity. So at purchasing power parity, the Big Mac test, Canadian dollars, probably 80 cents, 80, 85, that range. That's PPP, all of the things being equal. But when you factor in that on a trade basis, Canada is going to underperform because we have nothing the world wants anymore, and we don't have pipelines to sell the stuff that Asia needs from us, i.e. natural gas and oil, because we only have one customer called the United States. That's a problem for Canada. It's a big economic problem that the liberal left just doesn't fundamentally understand when they weigh that against climate change. And again, it's, I'd like to take Trudeau and give him one of these, but you're not going to change that. So there's a discount there for that. And in the short run, I think there's a discount. So 70 cents, another look below 70 is probably what we see before the dust settles and we're past the COVID thing and the global economies are starting to revive and the jobs are coming back. So another year or two probably of the Canadian dollars in and around these levels to weaker. And we're not going to see the Canadian dollar get to that 80, 85 range, fair value based on all kinds of labor costs and everything else that gets factored into purchasing power parity, until oil recovers and Canada's fiscal situation improves. And we're not the reserve currency of the world, so we're going to have a discount there. So that's kind of short and long term. And right now I've got more US dollar exposure. And if the Canadian dollar gets stronger, I'm going to add to it. Below 70 cents, I want to be hedged. What are we on time? We got time for one more question. When I listen to analysts say gold will go up because the US dollar will get weaker, is that true? So in general, yes, but gold is rallying in every currency in the world. And that's one of the great things here, because relative to every currency, gold is breaking out here, Lawrence. But generally speaking, there's a historical correlation, a weaker dollar and gold doing better. And it ties into interest rate and relative interest rate expectations and so forth. And that's part of the reason for that. But that's not the reason to buy gold. The reason to buy gold is what I've talked about in terms of real negative interest rates. The correlation to the US 10-year adjusted for inflation, i.e. the real rate, and gold is boom, boom tight the last 4 or 5 years. And that's the reason, Lawrence, you want to own gold. If the US dollar weakens, it's a plus, but on any given day, it doesn't have to go that way. Folks, thanks so much for tuning in tonight. And just a reach out to, if you can support one of our charities here, I would be eternal grateful. And we do a lot of work with these charities, cancer research at Sick Kids Hospital, and dementia and Alzheimer's research at the Baycrest Hospital here in Toronto. Both of these institutions, world leaders, very personal causes for Jared and myself. And if we can help you with your portfolios, please reach out to one of these websites. If you need help with your portfolios at BMO and want to learn more about what we do, in the sleep at night portfolios. If you are interested in our private debt and equity offerings and what that infrastructure investment is all about, and you qualify and you want to help us to help you navigate the storm going forward, please let us know at etfcm.com. If you're interested in independent financial planning, potential. And then there's more educational format at Golden Girl Finance with a focus on speaking to women. And if you're a financial advisor and want to learn more about how you can work with us and do some of these things for your clients, please visit Q Wealth. Thanks, everybody. Stay healthy, wear your masks, and we'll see you next month.